So let's talk a little bit about risk and how you determine what your comfort level with the risk of your portfolio is and whether or not your portfolio matches your own comfort level. So I go through a series of conversations with people. To start with, I say in 10 years, we look back at your portfolio returns and we, lo and behold, discover that your average rate of return per year is exactly what you had hoped for. What is that number? So let's assume you say that number is, I hope and expect I get 6% per year between now and the next 10 years. Well, we also know that the stock market and the bond market investments don't just produce 6% per year every single year. In fact, they go up some years and down others. The years that we get a positive or better than expected rate of return are great. Thank you very much, we'll take them. But the years that get a negative rate of return are the ones that I worry about. They're the ones that can sabotage a portfolio, and here's what I mean. If you have a portfolio, if you have an account that's worth $100,000, and it goes up by 50% one year and down by 50% the next, what do you have? Well, up by 50%, down by 50%, your average rate of return, of course, is 0. But what really happened is, your $100,000, when it grew by 50%, grew to 150, and then when it went down by 50%, it went down to 75. You, in fact, lost 25% of your original investment, and yet your average rate of return was 0. So the numbers lie. Chasing an interest rate isn't always in your best interest and does not always help you reach your goals in the most efficient way possible. So how do we safeguard against this? Well, I say to you, let's build your portfolio, let's make it look like a house, and let's build a floor that it can't go below, or shouldn't go below, according to your comfort level. So let's say you had $500,000, $500,000, and I said, what if that went down by 20%? From $500,000 to $400,000 in the course of a year. It was a bad market, but oh, by the way, your portfolio went down $100,000. Are you okay with that? Are you going to sleep at night, or are you going to pull the plug? Or is that too much risk, too much discomfort for you to absorb? And you say, too much. Okay, 20% is too much. It only went down $50,000. Went from $500,000 in a bad market, went from $500 to $450. Are you okay with that? Yeah, I think we can handle that. We can handle that downside. Okay, it went down partway in between, 15%. Went from $500 to $425. Went down $75,000. No, Bob, still too risky. Okay, we know that negative 10% is the floor that you can go to before you say, ooh, I'm not really comfortable. Negative 10. So statistically what we do is we work through the numbers and say, okay, under these circumstances, if your floor is negative 10, the worst you could do is negative 10, then based on a 6% goal, the highest you'd average would be about 22. Well, we do a little statistical calculation and determine that essentially 2/3 of the time you would be between the halfway points, or 14% on the high side and negative 2 on the low side. Okay, that's reasonable. And with 95% probability, you'd be between 22% and negative 10%. Okay, I can deal with that. But I have to point out that 95%, of course, is not 100%. Where's the other 5%? Well, there's a 2.5% chance that you'll do better than 22%. Thank you very much. We'll take that. But there's also a 2.5% chance that it'll do less than or worse than negative 10. And under those circumstances, that's when nobody has control. That's 9/11, the Great Recession. That's the technology bubble bursting. That is the World War I, World War II. Those are catastrophic events that take place that we are now dependent upon making sure that we've developed and designed your portfolio to withstand as best it can those circumstances. That's the worst of times when people tend to pull out, sell low, when in fact they should be buying high, but it's really hard to, buying low, but it's really hard to buy under those adverse circumstances. So let's test the waters here. Here's your portfolio, and your average expected rate of return is 6%, and your risk is up or down by 8. Now let's look at 8, by the way, as what it goes up or down 2/3 of the time. you'd be within that range. So let's use that 8 as a measuring stick. And the stock market, or the Standard & Poor's 500, depends on, historical average depends on when you look at it, but let's assume it was about 9. And the stock market averages a standard deviation up or down by 15. A little bit more risky. The bond market, let's just assume the bond market's average has been 5%. And that's pretty close per year. And the risk has been 6 to 7, up or down by 6 to 7. So where do you fit in this grand scheme of things? Well, your average rate of return is closer to the bond market than the stock market. And your comfort level with risk is closer to the bond market than the stock market. Under those circumstances, that's a pretty reasonable expectation for a rate of return compared to your level of risk. Fine. If you were expecting an 8 or 9% rate of return, I'd tell you a couple of things. Which would you prefer? Lowering your rate of return or increasing your level of risk? You always have choice. But this is our discussion to help you understand where you stand. So let's now transport this into and compare it to your portfolio. Well, we know that your worst case scenario would be negative 10%. Your rate of return is 6. Your standard deviation or your measurement of risk is 8. That would be a portfolio that would be approximately 36% in stock and approximately 64% in income or fixed investments, typically bonds. Now, where does your portfolio fall in comparison to what your comfort level of risk is? Now, this is not an exact science. This is just a ballpark estimate of what your portfolio might look like where in this comfort level for risk. So that's what we do to determine whether or not you're taking too much or too little risk, putting yourself in an uncomfortable position during a downturn in the market, which is really almost more important than the upturns in the market. So if you'd like to have more information about how this works, please let us know, and we're happy to share this with you.